Welcome everybody, and thank you very much for joining today's webinar. We're going to be covering the subject of, is now the time to move to cloud-based financial performance management? So welcome to the webinar. My name's Connor Blake and I'll be hosting today's session alongside our Bank BI CEO, Graham Goble. We really appreciate you taking time out of your day for us. I know that a lot of you may be joining for the first time, so I've put here on the presentation some links to the previous recordings covering some other subjects in our CFO series, and you can also access the previous presentation decks and information that we've had from those sessions. So before we start, I've just got a few housekeeping items to cover off. With so many attendees on today's session, I'll have to keep you muted, but if you do have any questions, just please do submit them using the control panel. We'll try and cover all the questions in our Q&A session at the end, and any we don't cover, then I'll be able to follow up in writing after the session. During the webinar, if you can please keep an eye out for polling questions too. So I'll be asking you to respond to 3 multiple choice questions, and each question is going to appear on your screen, and you can provide your response simply by clicking the option on the screen. So it's really simple, but I'll give you a bit of warning when those are coming up. And finally, as I mentioned before, we will be recording this session and you'll receive a link to that along with the supporting presentation and other material afterwards. So I'd like to start today's session with a view of the responses to the current events that I'm seeing from our banking and financial institution customers, and which areas of their business are coming under increased scrutiny. I see 3 main causes for pressure points at the moment. The first are constraints caused by heavily centralized infrastructure and services. The second is demand to support remote working for employees. And the third is a move to leverage or better leverage decentralized cloud capabilities. So everything has changed. I think one of the effects of the current events has been to question the suitability of traditional highly centralized on-premise infrastructure and applications. So overall, I believe we'll be seeing an increasing pressure to automate away manual processes. That's always been a trend, but I think this is going to be accelerating now. So IT, I can also see with being challenged for putting ownership of cloud applications into the hands of senior management within their own business functions. And that also includes the Office of the Chief Financial Officer. So what is the new normal? Well, I think we're all trying to work out what this actually means. From my discussions with banks, that means looking again at emergency operating measures that were put in place and really trying to make them more sustainable for the medium to long term. So most of you have already faced the challenge of supporting a shift to home working, and I think that trend is only going to continue. I've also seen in the news recently, and you may have too, that there's a number of banks are already announcing working from home as a permanent arrangement, or perhaps with a flexible 1 or 2 days a week in the office. So I think this means looking at measures designed to get the best out of people, while at the same time preserving their safety and well-being. And finally, the drive towards cloud capabilities and what this means for your business agility. So when you deliver via the cloud, you get to deliver in small increments, essentially, and over shorter timescales, which means the business can pivot where it needs to. And that's in comparison to committing to what previously were probably long, inflexible delivery programs, which are often very hard to change course. So cloud capability is a fundamental strategy towards improving business agility, and it also helps you adjust quickly as market conditions alter. For example, in the previous webinars and the polls, the survey results came out that over 2/3 of the respondents said that they believe that current events will permanently change how they serve their customers and employees. So what's stopping businesses being more agile? I've listed some of the common business issues that that come up in discussions with banks, and especially in the Office of the Chief Financial Officer. So monthly reporting means taking decisions reactively rather than proactively. Manual intensive processes take up the time of a lot of very highly skilled and valuable staff. There's often a heavy dependence on IT for the data, and that means that you're really just compiling old information, so often looking backwards, not forwards. And I think the overall effect of these limitations means that your response to change just can't be as quick as you really would like it to be. So to summarize a little about how I see the problem, I think this is a before and after situation. So I think right now, a lot of C-level executives and senior managers in banks and financial institutions, they've really got to be reactive based on pretty much what's happened during the month. So that's looking backwards and not really getting those actionable insights that they need on time. So that it makes it really difficult to pivot based on what's happening on a daily basis. To explain a bit about Bank BI, so what we've conceived Bank BI as a cloud-only solution, and it's really pointed at resolving those problems amongst others, and it's to help CFOs move from financial reporting and into what we call financial performance management. So we do that by delivering automated daily insights across the financials and the product portfolio. So that's really about being proactive and tracking leading indicators. Examples could be also reforecasting the balance sheet in real time, essentially getting actionable insights every day based on hard data from the business. So I'd just like to pause there for a moment to get your feedback on what we've just discussed. So what I'm going to do is, in a moment, is launch our first polling question. So that will appear on your screen in a minute. So the question is, do you need a solution to improve financial performance rather than just report at month end? So if you bear with me 1 second, you can see the responses there. Now I'm going to launch the poll now, and that should be appearing on your screen. So if you could just take a moment, please, to understand the question and then let me know your thoughts on that. So do you need a solution to improve financial performance rather than just report at month end? So yes, if it's A, and it would help your decision-making process. B, if it's not a high priority for you at the moment. Or C, in fact, if you're not working in a financial institution. So I'll just give you a few moments to collect those responses. Okay, so I'm going to now close that poll, and thank you very much for answering those. I will be sharing the results of the poll with everybody after the session. So now I'm going to hand over to Graham now, who's going to share some thoughts on the essential things that you need to know every day to manage your financial performance. So Graham, if I can just hand you control, bear with me 1 moment. Control should be with you now.
Thanks, Connor. Yeah, hi everybody. Let's start by considering the main things or areas a bank or credit union needs to measure and monitor in order to manage their financial performance. Firstly, you need to grow or manage the balance sheet. This means you need to be able to track new production in terms of loans and deposits. In addition to managing the balance sheet, I think also you need the ability to realize efficiencies. Sorry, Connor, I'm not getting the ability to advance. And realizing efficiencies implies you need to be able to not only monitor costs and expenses, but also be able to assess how efficient or productive the bank is. So tracking performance measures against full-time employees is a good way to measure performance and whether efficiency is getting better or not. The third area is monitoring performance, and this really talks to tracking volumes and rates on the loan and deposits, tracking the net interest margin. Another key element is also the non-interest income. as this can make a significant impact on both profitability as well as less strain on the capital ratio of the institution. So if we translate these three areas into and drill down on these into the things we kind of would like to do within growing the balance sheet, realizing efficiencies and monitoring profitability, we can maybe step through onto looking at the various components of each of these areas. So let's drill into growing the balance sheet in a bit more detail. As you can see here, we can consider, if we consider loans, firstly, then the loan analytics or the loan funnel, loan origination is a good place to start because it's monitoring the loan applications as they progress through the underwriting process, gives a good indication of what will be arriving and coming onto the balance sheet. The ability to analyze by channel and product and loan officer and underwriter gives us a good indication of the future product mix, rates, the type of credit quality, and these are all key ingredients in terms of looking at future profitability. Once a loan is approved, of course, and funded and dispersed, then the ability to measure new production in real time, day by day, really helps us track how we're progressing against target and against budget. Again, being able to carve out new production as a subset of the data and measure that by, say, branch or channel, loan officer, by product, or by other customer or member segments, lets us identify the areas that are performing well versus those that are doing less well. All of this, all these results, of course, or feed into the balance sheet. So the ability to monitor these key ingredients on a day-to-day basis to see how they're impacting the balance sheet in real time gives us the chance to measure performance continuously through the month, even if we only report it on a monthly basis. So really, the analysis that I'm laying out here should really support the day-to-day monitoring and measurement of performance within the financial institution. So we translate that into maybe some of the analytics that we are able to provide to support our customers on this journey. This screen here is showing us the loan application funnel. So these are our loan origination, loan applications as they're being captured by the organization. These could have come through various channels. And down in the left-hand side, we're seeing the total applications. We can track this on a month-to-month basis. We can track this against previous year. And then we're able to break those applications down into the number of applications, maybe the dollar or currency equivalent or currency volume of those applications, and the average loan application size. And then as those applications go through the various underwriting process, they will either be approved, funded, or denied, and we'll probably want to capture reasons for denial, or they might just simply be incomplete or cancelled or withdrawn. So the ability to track that funnel on a day-by-day basis, on a monthly basis, analyzing it over time by different criteria allows us to really get an indication of where our lending is heading and what's likely to be coming onto the balance sheet. At the top of the page are a series of funnels and filters, and what these filters allow us to do is to break down these consolidated loan application numbers by branch, by region, maybe by product group or product sector, or by other channels. So maybe we have a digital channel versus on-premise branch channel, or maybe we've got various initiatives or campaigns that we want to track the loan applications against. And so again, the ability to segregate out and segment out various components of the loan application funnel is a key capability within the reporting suite. Once that loan has been funded, then obviously we need to track it both in terms of its number and its, again, currency value, and basically track that new production as it comes through the organization. And the ability to separate out new production, new lending from the total portfolio, from the portfolio that's non-performing, is an important capability to understand the impact that new production is having on the total portfolio and therefore our performance. So being able to track and trace this information against the organizational structure, as we're showing here, is a key ingredient. Being able to see the number of new loans in the month, the currency value, the average size of those, the weighted average rate. So we can immediately see whether the weighted average rate of the new production is better or worse than the total portfolio. And also we can see what proportion of the portfolio is non-performing. And we can use different criteria or standards for the definition of non-performing. That might be just non-performing par 1, or it might be par 30, par 60, par 90. We're able to accommodate different ways of analyzing delinquency on the portfolio. So this gives us the ability to track and trace new production against the branch network. Equally, we may want to do this and look at it in terms of various other criteria at a product level, but also being able to break out the non-performing performance at the branch level in more detail. So I mentioned earlier, we could see this at different par levels. Here we're selecting everything that's past due versus things which are past due greater than 30, or greater than could be greater than 30 in other buckets like 60, 90 days. In addition to that, we might want also to take the view of the portfolio in terms of product performance. And here, rather than looking at it through the branch and region or channel structure, we're looking at it through our individual products, or in this case, looking at a segment by credit cards, looking at both the volume and the percentages, and looking at the number of clients that have those products, and really getting into the granularity of looking at portfolio by product. All of this can help us feed up into our financial statements. So again, whilst we're not going to necessarily publish a balance sheet or an income statement on a daily basis, the ability to track the information in terms of new production, see that flow through the organizational structure, the product structure, looking at it by loan officer, by product, allows us also then to see it roll up into the financial statements. So we're able then to track new production, new lending, and clearly during these difficult economic and challenging times, there have been a number of implications on the loan portfolio, whether it's rescheduling loans, whether it's government stimulus packages. In the UK and the US, we've seen significant payroll protection lending hit financial institutions' balance sheets, which is causing or has created liquidity, cash flow, as well as challenge in processing those loans and getting those loans through. In other countries, we've seen rescheduling of entire portfolios and the impact that that has had in terms of cash, liquidity, and profitability of the organization. So the chance to see this information in a consolidated, coordinated way, coming through the core systems into the financial systems, and seeing that all in one place that can be reconciled back to a single version of the truth, is a really key component of a performance solution. If we're looking at the profitability side of the equation, then we really need to think about the yield on our loan portfolio through the interest income versus what we're paying in terms of interest expense on savings and deposits. In other words, our cost of funds. And the difference is obviously the net interest margin. And this is, of course, a key component of our profitability. Another component that can adversely affect our profitability is obviously non-performing loans. And I've talked about that a little bit earlier, but the ability to see and track non-performing loans and trends, and to subsequently measure the charge-offs and write-offs, is an important element of understanding the profitability equation. And that profitability equation, again, feeds through into both the balance sheet, but also mainly the income statement. So again, the ability to see and track and trace elements of profitability as they occur during the month is an important component of being able to prepare income statements within the management accounts in an automated way and in an accelerated way, without, as I say, having to run significant extracts, without having to run those Excel models, without having to involve IT in the processes to do so. So the free flowing of information on a daily basis through all of these areas and into the financial statements gives us the ability to not only track and monitor performance, but also gain efficiencies in the production of our management accounts and our regulatory reporting. So if we drill into that in a little bit more detail, what do we need to be able to see? If we're talking about net interest margin, and we're talking about the yield on the loan portfolio, then simple charts and graphs that can show us how that yield is running, what the cost of funds is, what the margin is going to enable us to really track this and be able to track this at a consolidated level, at an individual product group level, whether we're looking at mortgages or personal loans or other types of lending. This allows us to get down into the granularity of the not just the total loan portfolio, but all of the elements that make up that loan portfolio. Similarly, in terms of the cost of funds, what are we interested in? We're particularly interested in looking at what we're paying in terms of interest expense, in terms of savings and deposits. We're probably interested in breaking that out into a number of segments. What are we paying to customers that we see as relationship sensitive customers, those customers that are banking with us, maintaining their current or checking accounts with us, using us for banking services. We might take a different view in terms of what we're paying them in terms of savings accounts versus more traditional term-based products like CDs or fixed-term deposits. Those customers may well be more rate sensitive. So the ability to separate out relationship sensitive customers from those rate sensitive customers and understand the mix of those two and the blend that they produce to create that cost of funds is an important element of understanding and monitoring the profitability of the interest expense calculation. Taking that forward then, we talked about looking at past due loans, a solution that can allow you to break that down by different past due loan buckets, look at it over time through trends, looking at it beyond just the highlight headline number as well. So looking at that by branch, looking at that by product, looking at that by loan officer. And again, allows you to break down the overall numbers and see elements of performance based upon the key attributes, be they organization, product, or staff, that really go towards driving the performance of your bank or credit union. And then being able to summarize that and roll that up and track that over time is really important. So in this chart here, on the left-hand side, we're tracking the total loan portfolio in terms of its currency value. And then on the right-hand side, we're tracking both the past due 30-day and past due 60-day categories. So is that trending? Are they trending down? Are they trending up? 30 days, 60 days are giving us a leading indicator into potential write-offs and charge-offs that we may have to make. So again, being able to see this consolidated for the whole portfolio, but equally being able to see this broken down by organizational structure, branch, or by product structure and hierarchy, or by loan officer, or by customer segment. Clearly, there's an interrelationship maybe with credit quality and the credit score of our customers. So where we have things like credit scores, analyzing the portfolio against credit range can be a really useful tool, not just once the loan is on the books, but also obviously through the loan application process itself, capturing credit score at that stage and being able to monitor the credit quality that we're writing onto the books is obviously an indication of or a key parameter that we need to monitor and measure in terms of the quality of the portfolio going forward. So those are some of the key elements that I think drive those particular areas. And as I said, they all come back to and feed into the income statement in one shape or another. And so the ability to, again, track the income statement, interest income, interest expense, any provisions, fees, other income on an ongoing basis becomes a really key element of being able to monitor our performance. And what we typically want to do here is measure day-to-day movement as we move through the month, measure month-on-month movement as we analyze our performance against previous month, compare ourselves to budget or plan to see how we're doing against the strategic plan of the organization. And then finally, looking at that in terms of not just the monthly numbers, but the year-to-date numbers. Are we on track? How do we compare to this time last year? Is our performance, getting better or getting worse? Obviously, the breakdown and depth of the interest income, interest expense, this will derive right down into the chart of account lines that you typically have within your financial statements. And this allows you to start with a high level, but increasingly drill down into further detail. So as you go through the month, not only are you looking at income side, but you might well be tracking something on the expense side, maybe tracking overtime expenses, maybe tracking other system expenses. And I'm sure as we've gone through these difficult times, number of our expense patterns have changed significantly with staff working from home. So again, the ability to monitor that on a day-by-day basis is giving us the chance to actually understand what's going on and be able to react to change in a more timely way. So this analysis that we have is very comprehensive in terms of, again, capturing all of the key components that lead up into the financial statements, being able to measure and monitor them on a day-by-day basis with the sole goal of being able to be in command of the numbers in terms of what's driving performance. And this all leads again into the ability to quickly and swiftly automate the financial reporting at month end. The delivery of hard copy financial reports is obviously a key component of the responsibility of the Office of Finance, as is the ability to feed this information up into regulatory reports that may be required by the regulator, central bank, in terms of meeting our obligations. So we see that there is a complete and total connection between the flow of this data into a performance management tool, through into the financial reporting at various period ends, and then into the regulatory reporting solution. And all of this can be supported through the one cloud-based product, and it can be supported from a single data model with one single version of the financial truth. So with that, I'm going to hand back to you, Connor, for the next section.
That's great, Graham. Yeah, thanks very much for that. So I think just to finish off that third part of the story here, really, we're talking about driving efficiencies. So what we mean by that is around capacity planning. So I'm going to focus on loan applications and the loan application funnel, and whether you can spot, for example, a lack of underwriter capacity in the organisation and any bottlenecks. From a productivity ratio perspective, how those can help you track how productive your employees are, and that's of particular interest now to get those sorts of metrics as we see more and more people working from home or in a very changed environment. And then also I'll have a brief look at how to manage costs, and that's touching on some of the comprehensive branch and departmental expense analysis that we cover as an example. And how all this leads into the P&L and income statement. So I'll start with a quick look at our loan funnel analytics. Graham's obviously introduced that just previously, and this is where you can track leading indicators. And it gives you a status for each loan application, for example, how long since it was originally made or by underwriter. This view of your loan funnel applications really should let you proactively manage capacity, performance, and the conversion rates on a daily basis. So we break down loan applications into denied, approved, and funded, and Graham obviously touched on some other aspects that we measure there, but you can drill down at any time into branch and regional level. You might want to have a look at it through a product lens, for example. So if mortgages, businesses, personal loans, or any other loan types are of particular importance to you, then you can quickly filter those and take that view. And you can further subdivide applications by attributes. So you can quickly get a view, for example, of channel, the campaign, or a sector, or just segregate it by by business lines. And the idea is that the variances are immediately visible by business line or by number of loans and by the dollar value. So if you have in a position where your loan funnel and your loan origination is fully digitized, then you get daily updates. So you can always make sure that you've got the underwriter capacity in place so that the loans flow onto the balance sheet smoothly. So as you can see from what Graham's discussed before and looking at this, there's really a lot of granularity that you can chart and graph to follow the status of the loan applications. How many did you receive or approve, and you can easily filter for comparisons against, for example, month on month or year to date. So just moving on to productivity analysis, or an aspect of productivity analysis, with so many changes that are impacting your workforce, a lot of businesses are really wanting to focus on productivity, so you know where you need to apply your resources to improve performance. So in this example, you get a detailed productivity analysis based on headcount, and that lets you track multiple metrics. So again, you can do this on a month-to-month basis. Yeah, you can also see the year-to-date averages, and you can see all the variances, and then drill right down from those into the underlying information and data, right the way down to the individual GL account line that relates to it. There's also trend charts that help you visualize those changes too. So as Graham was pointing out, those are just a quick snapshot to help you understand where the trends are going and then to further investigate into that. So you can filter the productivity ratios against the averages, for example, or the actuals, and you can drill down from, as I mentioned before, from any of these dashboards to the underlying GL account. So that you can really easily get that granular view of what's influencing the changes and then take appropriate action. Costs. So just taking a look at how we can help manage costs here. So Bank BI effectively molds itself to your chart of accounts. So you get a complete view of your financials. So when you need to focus on costs and managing costs and expenses, you can quickly do that by type, for example, and you can compare the budget against actuals for the dates that you want, and then again compare against month on month, year to date, or against this time last year, for example. That could be by branch or by business line, and again with those changes are all highlighted so that you can take action quickly. So continuing on with the theme of the income statement for a moment, you can get a better understanding of your key business drivers and what's changing on a daily basis. So this example here provides a snapshot of key information. The idea is that you can really take informed business decisions. That could be based on, for example, movements in your loan loss provisions, interest income and expense, or net interest margin and the changes from the previous day, or the month, or the year to date. So we give you a complete standard set of key ratios out of the box. So those can be configured and you can show the information in the order that will be most interesting for you. So for example, that could be loan to assets or loan percentage to total deposits, or you might want to focus on operating costs, expenses and provisions, and any of the changes on a daily, monthly or year to date basis. So once we've got a snapshot of your GL financials and the loan and deposit data, then we're able to automate the production of the prudential regulatory reports to the central bank. Now, I've already covered this theme in a lot more detail in a previous webinar session. So you can watch that video. I'll send you the links and you'll get a deeper dive over a 45-minute session into exactly how we do that. But to summarize here, Bank BI is effectively the reconciliation tool to the regulator chart of accounts. So we take care of executing all the calculations, applying all the business rules, and making the adjustments for you. So the end user effectively just has to simply select the dates for the report they want and download it. So we think of that as the ultimate end user experience for regulatory reporting, especially considering a lot of the challenges that a number of customers were facing before they came to Bank BI. So in summary, and before we move to the next polling question, you've seen effectively three aspects of three key applications. So that's financial performance, so all of your daily financials and everything from your GL. What we call banking performance, so there's comprehensive daily loan and deposit analysis. And then lastly, as I touched on, the regulatory reporting, where we automate the creation of the regulatory reports. So I think with that, I'm now going to move to the second polling question. And I'd like to, in this time, get an understanding of your readiness for cloud-based applications. So the question is your bank cloud ready for this type of application? And it's A, if you have a cloud first policy, B, if you have no specific cloud policy, C, if it's never cloud, or D, effectively, if it's not applicable or you don't work in a financial institution. So if you bear with me, I'm just going to launch that now. So that should be appearing on your screen. And I'll give you 30 seconds or so to answer that question, and whether it's A, B, C, or D. I'll just give you a few more seconds just to gather the last answers. That's great. Okay, well, with that, I'm just going to close that poll, and I'll move on to just discuss briefly what I'm seeing out there in terms of management decision frameworks, let's say. So really what it is just saying, well, what do we see in the market amongst our customers, and also through other engagements with banks and partners about the reaction to the current situation. So I'd be really keen to get your feedback on how your business has tackled the pandemic in particular, and at what stage you think you're at. So based on those discussions, as I say, with our customer base and partners, I think there's really three main modes that are happening. So in emergency mode, it's what's happening right now for some of you. So that's keeping essential banking services open, making sure staff can work remotely, and supporting urgent customer support needs. So this also means making sure that the digital and mobile channels are able to cope with increased demand that we touched on previously. But really the focus for a lot of those businesses in that stage is on really just change freezes, while trying to work out what and assess the impact on their business of current events. We've talked before about into the new normal, and I think what that is for a lot is between probably now and September. So a number of businesses starting projects that support cost optimization initiatives, looking at strategic cost cutting, so being able to identify and measure where savings can be made, or monitoring a situation on a daily basis, particularly where new credit policies are being rolled out, and trying to measure their impact. I think this phase also from many banks and financial institutions is about adjusting operational delivery of services and to support customers and employees, and help make that more sustainable for the medium to longer term. And a lot of them, as a result of that, are evaluating options for automation in the business, and including aspects of financial performance management that I think we've discussed today. Then finally, from October onwards, rolling out a more strategic measures. So over the following 3 to 6 months from October, a lot of feedback says it's going to be allowing, trying to enable business executives to be more agile and increasing speed to results. So for some, that means focusing on new channels and cloud capabilities. But for most, it's about faster time to results, and also de-risking of decisions. So in this phase, I think really projects, if they're going to go ahead, have got to help strategic planning capability in particular. They've got to be delivered remotely, and they've got to be delivered faster than ever before. So I think with that brief summary, I'd like to get your feedback and just test my understanding of where you are at the moment. So whether you're coming out of change freeze mode and into project mode, if you haven't already done so. So I'll be launching this third and last poll in a moment. So it's A, if you'll be, so the question is, when do you expect to come out of change freeze mode and approve new projects, if you hadn't already done so? And it's A, if it'll be between now and September, B, for October to December, C, if it's still not clear or you're not sure, or D, if it's not applicable or you don't work in a financial institution. So I'm just launching that now, and again, I'll give you 30 seconds or so to please let me have your response based on what we were discussing just before. Just gathering a few more questions, also responses. Okay, just give you 5 seconds or so. So anyone who would like to can do so. Okay, so I'll be closing that poll now. Thank you very much for your responses. Now, I think with that, Graham, if I could please hand over to you, I think to give us an overview of our customers, and I think some stories about how we've been able to help them.
Yeah, sure. Thanks, Connor. So Bank BI, we now have over 60 customers in more than 40 countries. And these customers range from banks, credit unions to the microfinance industry. We serve all of these customers from a number of Microsoft Azure public cloud data centers around the world. And we manage this network from here in the UK. As a cloud-only company, we're ideally placed in today's economic climate to run projects remotely, where no investment in infrastructure is required by our customers, and to be able to provide our applications and service really by a very simple annual subscription agreement. So it's a truly software as a service solution, and this allows us to work with and become true partners with our customers, delivering daily performance management solution, whereby we both have a shared goal to ensure success and delivery of the application and the values that we're able to create on a daily basis. As a cloud-only company, the transition to home working has been relatively straightforward to us. A large part of our workforce was already home-based, and so we've had a fairly seamless transition into working from home. As a cloud-only solution, we have no infrastructure in terms of hosted computer services. We're using everything in Microsoft Azure as the platform. And so we're really able to leverage that kind of cloud-only decision we made 6 years ago, and the fact that we have a very mobile workforce. That mobile workforce is able to support our remote implementation standard, which is how we've run all of our projects. And so really it's been business as usual for us through the pandemic, and the ability to support clients anywhere has really helped a lot of our customers continue with their projects and realize the value from our software. One of those customers is Vision Fund International, and they are basically the microfinance subsidiary of World Vision, the children's charity. And they use Bank BI in around 30 countries around the world to monitor not just their financial performance, but also their social and outreach performance. As a microfinance company, they are particularly interested in empowering women, their mission statement to help raise children out of poverty. And to do that, they have, as I said, subsidiaries or microfinance institutions in more than 30 countries. And what we're able to do is provide them with a solution that can work in country to help them monitor the loan portfolio in individual countries. But we're also able then to roll that information up at both a group and regional level to provide a consolidated view of the business as well. So with more than 30 financial institutions in different countries around the world, our ability to take data from multiple core systems to provide a standardized view of that information has really allowed us to deliver to them a very agile and rapid time to value solution. So this creates an opportunity for them to really focus on the business needs in terms of performance and reporting, rather than focusing on infrastructure needs. They don't have to worry about licensing of technology, of the network, of the database layer, and those types of things. All of those elements are wrapped up into our subscription service that we provide. And so really this does allow them to focus, as I said, on the reporting and performance needs, and not on the technology that's necessary to run it. This model we've implemented in a number of other institutions in a multi-company scenario, but it also works just as well for an individual financial institution. So as I said, we have banks here in the UK, in the US, and other parts, Caribbean and other parts of the world, Africa, but we also have microfinance organizations in the United States, as well as many other microfinance institutions around the world. So the single solution approach that can adapt itself to the chart of accounts, the product set, the organizational structure of our customers is really fundamental to our success. We only have one version of our solution, but it can be configured to precisely fit the financial and performance needs of our customers. So with that, Connor, I'll hand back to you.
That's great. Thanks very much indeed, Graham, for that overview. So I've been tracking a number of questions that have been submitted during the webinar. So thanks very much for your patience whilst we've been waiting to get to those. A number of them tackle similar topics. What I've tried to do is consolidate those into 3 questions. So given our time constraints, I think that's probably what we'll be able to cover. But as I say, anything that we don't cover today, then I will be providing a written follow-up afterwards together with Graham. So let me get to the first question then, Graham. So the first question, I think, to you is, has the Bank BI operating model had to change as a result of the pandemic?
I think I've pretty much covered that already. I mean, no is the answer. I mean, cloud-only company with a remote workforce. I think what we've had to do is ensure that meetings and other discussions that might have happened in office now happen remotely via other video conference type tools, so that we just get into a rhythm and a flow of being able to manage and monitor our business in terms of delivering implementations to our customers. So the transition was relatively straightforward. We already had the tooling in place, being a cloud-based company. So I think it's been a fairly seamless transition for us. And I think some of our banks and customers have appreciated that we haven't been adversely affected. Clearly, many have in terms of their own provisioning of remote access to systems. And that has been a challenge for them. But for us, it's been relatively straightforward. So we've been able to continue with business as usual.
And I can certainly attest to that, being an employee myself. So yeah, and certainly been able to keep that flow of communication and support with all of our customers worldwide as well as with our fellow employees. So let me pick out another question. So we go to the second question. What sort of application changes have your customers asked for in your system as a result of the pandemic?
Yeah, that's a good question. I mean, having a fairly mixed range of customers, from microfinance to credit unions to banks, we have seen a number of different requirements. In the US community bank market, the stimulus package for payment protection loans meant that there was a need to focus on some more daily reporting to help support the very swift and rapid changes that were occurring through while that stimulus package was running and those loans were being taken up. $2 trillion flowing into the banking system and ending up in loans is obviously all ending up in banks and other institutions' balance sheets. In other parts of the world, especially in the microfinance, we've seen some countries mandate a total rescheduling of the loan portfolio. So identifying restructured, refinance, and rescheduled loans has been a key element for some of our customers. So I think in summary, I'd say it is a slightly fine-tuning of some of the reporting to enable our customers to identify those incremental changes, some of them significant, that are happening within their financials, their balance sheet, and really positioning them, I think, just as much doing it kind of now as it's happening, but also as all of this unfolds. And clearly this is a long-term problem that's going to reflect itself in everybody's performance and balance sheet and income statements. The need to be able to segregate out those loans that were restructured, etc., refinanced is going to be important going forward, especially as we start analyzing delinquency and non-performing loans in the future. Relating those to those other events is going to be a key element of performance management. Back to you, Connor.
That's great, Graham. Thanks very much. So I had a few questions around a similar topic, and it's really about how long would a project like this take, and what sort of commitment would be needed to support it. So if I summarize that into a third question, what sort of time commitment and resources does the bank have to invest for this type of project?
We'd like to think, and we do think, and we do know, a lot less than I think people generally think. A lot of the information that we need is already in the finance department. So if you think about a trial balance for general ledger for producing management accounts, that's the sort of level we need of information we need on the financial side. If you think of lists of loans and deposits and savings accounts for customers that you might use for, say, an asset liability solution or asset liability management, that's the type of information. So in summary, we need about 25 fields on a loan and deposit, about 7 or 8 fields on a customer or member, and we need maybe a half a dozen fields on the general ledger side. So our aim is really take that data away, do the financial mapping and configuration of our system ourselves to meet a known target. And the known target is the management accounts and board reporting, if you like, of the bank or the credit union. So by taking away the ingredients, we're able then to assemble them into our solution very rapidly in a few days and come back with a configured, ready-to-use solution. So to answer your question, the commitment from our customers is to provide that information in the first place, to support us as we reconcile it back to those known management accounts. And then thirdly, to really user acceptance test the solution once we present it back with a full set of history, financials, and the daily production process running to feed those files into the solution. So it's a relatively light implementation process. We have our own financial analysts who are all worked in banks and before, and therefore worked in finance departments, who can quickly apply themselves to mapping charts of accounts and things like that. So our aim is really to make this as light as possible for our customers, and to have a minimum sort of starting point, a gate we need to get through, if you like, with reconcilable information back to a known proven output, such as the management accounts. And then what we're able to do is replicate that reporting very quickly in the application and deliver the solution for testing. So we see a project as requiring a few days of the customer's time, maybe over typically at least over a month end. So maybe a project looks like a 6 to 8 week engagement. We would typically spend around about 10 days of effort on our side to configure and support all of that. And we'd need maybe same sort of commitment on the end user's time to test it, take it on, and provide the information in the first place. But as I say, we're typically not asking for anything that's not already existing within the finance department.
That's great, Graham. Yeah, thanks very much for that complete answer. Well, I think we've had a couple of other questions, but I think we're going to have to cover those offline now, because just in order to respect everybody's time here, I think we're going to be coming up to an end of the webinar. So as I say, we'll both follow up with those any further responses in writing. So thank you very much to everybody who submitted those questions. I hope you found the answers to those three of interest or enlightening. So I think now just to move to the final part of the webinar just before we close. So you're all invited to take a look at the our online demo system. So it's a fully featured system, so you can really get to basically navigate around at your own pace and get to know the applications that we've discussed today. I'm available and in order to provide you with a guided tour if that's what you'd prefer, so quite happy to do that. Or alternatively, you can get hold of me and we can have an online meeting if there is a specific project that you have in mind that you'd like to discuss. So by all means, contact me via my email. There's also via the website, there's ways that you can submit requests or book meetings as well. So that's all very simple for you. It can fit with your diary. But with that, I think just to close off the webinar, I hope you found the session helpful. As I say, I will be sharing the recording and presentations probably next week now, so probably around Tuesday by the time those go out. Keep an eye out, please, for our next webinar in August. I'll be sending out details of that closer to the time. And lastly, I know your time is extremely valuable, so I'd like to thank you all really for your participation and engagement so far. So thank you once again for attending, and I'll now close the webinar.